Hello there guys, welcome to the sharpening session. Today is July 24th, so it's a Saturday. Hopefully you guys had a good trading week so far. Now the sharpening sessions, for those that might not normally join, or maybe this is the first time that you've joined, sharpening obviously being over the weekend when most markets are closed, means this is the time that we take to delve into things in a little bit more depth, answer questions that we might not have time to answer or answer properly when we're in those live trading environments. So these are really sessions for you guys to clear up any questions that you have and to understand more about strategy, if and when kind of scenarios. If this happens, should I do this, should I do that, and sort of clear up those little bits. Now, I always have a topic in mind, always, so I will go through that unless I see other questions come in. So I'll keep my eye on the chat boxes and just see any questions that do come in, and of course I will address them, but otherwise I will go into a particular topic. Today it's going to be understanding the auto climate and the ATR in the auto climate. If you don't know what those words mean, don't worry, I will get to explaining it obviously. Now, just to do a short introduction, for those again that might not know, my name's Becky, so hello. My email address is here, becky@traddictiv.com. There's also support@traddictiv.com, so you can use that as well if you have any questions or need any workspaces or anything like that. You can send them to those email addresses, Becky or support@traddictiv.com. Now there's also a link here which I will just bring you to, which is going to be this one actually. If I can find it, there we go. tradewithufos.com/Becky. Now, I'd rather you guys go here to ask questions, and the reason for that is once you go to this link and you set yourself up with a free Trade with UFOs membership, if you don't have one already, then down here you'll be able to ask a question in a public setting. Now that's great because it means other people learn from that question because the answer is also posted. So in fact, the question that I'm going to go through today and the explanation that I'm going to go through today came from a question which was using EMA, I believe it was this one. Here we go. So somebody asked a question. Thank you to Steve, by the way, for that question. Asked a question here in this public setting asking about whether or not if the UFO is far away from the EMA and what we do about that. I then answered, and I even said here I may do a sharpening session on it today, so you can watch that. So by posting questions in that space, I can answer it there, and it also gives us questions that we can use in sharpening, again, to expand and explain and help other people out. So I would appreciate you posting questions there if you're comfortable to do so. Okay, so I just need to cover the disclaimers first, just before we officially get started. So she says, there you go, they are coming up there. Obviously important for legal reasons always for you guys to read disclaimers and understand that these kind of videos are instructional, they are educational, they are demonstrations, but ultimately it's up to you what you do with it, and it doesn't necessarily show you the results that you may receive. Okay, so just to explain very quickly how these sessions work, if you've never joined us before, you'll understand that on our YouTube, Facebook sessions, what we do is around about halfway, we will cut off the live stream to Facebook, YouTube, etc., and we continue in our closed coaching environment. Now we do that because people pay for the closed coaching environment, $21 per month, and so because of that, they've essentially purchased to have more access to us, more of our time in that closed environment. So we do our sessions and we cut them off around about halfway. When we're in live trading environments, then we might place a trade or two before we cut it off. We'll always make sure we at least place one, so that if you're watching for free on those free channels, you still understand what we're doing, you've still got some trade ideas. In sharpening, of course, we're not trading, so I tend to do it in such a way where I'll answer the questions that will come through from those free places first, and then obviously continue in that closed coaching environment around about the halfway mark, so just so you're aware of that ahead of time. Okay, so sharpening. I'm just checking the chat boxes here. I can't see any questions come in, so I will go ahead with the question that we had through that tradewithufos.com/Becky and what that means in terms of auto climate. So the question, if we just come back to it here, the question, which was the question about using EMA. The question was, let's say I find a price chart where the common time frame EMA is in a UFO band. Based on the methodology, we are supposed to set up a trade to trigger when price hits that band. Definitely. However, what if it takes a couple of days to reach the UFO band and in the meantime the EMA is no longer in the band? Does that happen often, and would we cancel the trade then? Now, the first answer to that question, which is actually the last bit here, would we cancel the trade then? Yes. If the EMA is no longer lining up with the UFO band, we would cancel the trade. Now, as I've explained in this answer, and I'll read this first and then I will show you and expand on that in terms of what I mean. So with this one, I've said here, you're spot on. If the EMA no longer lines up with the UFO, we would cancel the trade as it's no longer meeting our criteria. The way to avoid it happening too often is to place trades that are closer to you at the time. You can use AutoClimate to help you with that. If the dot has a long line coming out of it, then current price is far away from the EMA, meaning by the time it moves into your UFO, things are less likely to line up. If the dot has a short or no line coming out of it, then current price is really close to the EMA, meaning it's less likely to change by the time it hits the UFO. So let me expand on that. That was going to be my theme for today. Let's expand on this. So I'm just going to bring up TradingView. And we've obviously got AutoClimate here on the left hand side. Again, I'm keeping my eyes on the chat boxes here if you guys have any questions. If I say anything that confuses you, of course, let me know. These sessions are for you. So we have AutoClimate here on the left hand side. In fact, let me move that right out of the way. There we go. So it's easier, I don't have a line in the middle of it. So we have AutoClimate here. Now we have different numbers at the top here. We have lines, we have dots, we have lines that go above the dot, we have lines that go below the dot. So let's expand and understand what this means. We also have, by the way, numbers here as well. So what do they mean? So first things first with AutoClimate, for those that don't know what it is, what AutoClimate does, what its main function is telling us where we have probabilities. Do we have probabilities up? Do we have probabilities down? If we have a thick blue dot, ignore the line for now. If we have a thick blue dot, that tells us probability upwards. If we have a thick red dot, say like that one, that tells us probability downwards. If we have thin dots of either colour, that tells us probability neither way, and therefore we would choose to do nothing. So it really helps us answer that question, should we buy or sell or do nothing? That's what we use AutoClimate for, and AutoClimate is a free app which you can download on most platforms. So, sorry, not most platforms, on most of the platforms that you can download it on, it's free. That's what I meant to say to restructure that sentence. Okay, so with AutoClimate, it helps us answer that question, but it's got other things going on which can actually be really, really helpful if we understand them a little bit better. Now, first things first, and we've gone through this on a separate sharpening, but I'll just summarize really quickly. These numbers up here. These numbers up here, the first number tells us how often that market usually goes in that direction for, or how long it usually goes in that direction for. So if it says 7.03, that means this market would usually go up for 7.03 candles. Now we always round that up to 8, or round it up to the closest whole number, because you can't have a percentage of a candle, right? So we round it up. So what this tells us is that the market usually goes up for 8 candles. If we had a downwards climate, then we would be looking at this second number. There you go. This second number tells us how long that market usually goes down for. So in this case, 3.37 candles, round that up to 4, usually goes down for 4 candles. Now, why is that helpful to know how long it usually goes up or down for? Because we can then look at this last number, which tells us how long that market has currently been going in that direction. So we have an upwards climate at the moment, so we know it's been going up for 2 candles, and it usually goes up for 8 candles. So that gives us an idea as to, based on what usually happens, how much room we still have to catch that move and continue it up, based again on what usually happens. So those are what those numbers mean. Now that's all great. Hopefully that's helped you understand a bit more about AutoClimate, but that doesn't answer the question about if the EMA is not in the UFO and what that means. This is where we come. Let me move that out of the way. This is where we come to the lines on our AutoClimate. She says. Here we are. Cool. This is where we come to the lines on our AutoClimate. So these lines, you'll notice, are obviously different lengths. We have lines beneath the dots. We have lines above the dots. What does that mean? Now, essentially, the closer the line is to the dot itself, so let's say, for example, let's take this one right here. We highlight this one right here. This one right here does not have a line, or doesn't have a visible line coming out the top or from the bottom, which means at this point, and we'll come straight up from here. At this point, price had a confirmed probability upwards, there we go, and was at the EMA. That's what that means. So if the dot doesn't have a line either way, then that tells us current price is at the ideal trading price. And the ideal trading price that we use here is going to be our EMA. So if price is at the EMA and you have a UFO at that price, then great. It's not going to move away from the UFO. They're going to coincide. So let's say, for example, at this point in time, this was current price and the current price was this price right here, and you had a UFO right here, and the EMA was at current price, which is here. You have a trade set up right now you can take right now. And it doesn't matter what happens, it's not going to move out of coinciding at the time of triggering, because it's pretty much already at the time of triggering and it's ticking all of the boxes. Now, what if we have a really long line? So let's take, for example, I'm just squishing that down a little bit. Let's take, for example, this one. This is the biggest one that we have so far. So this one here, we just point to that first, that's got a really long line. That tells us that at that point in time, current price, it's not current now, current that it was then, was quite far away from the EMA. It was a big difference. Now, why is that helpful to know? Because if we had a confirmed upwards climate, and again we can see it here visually, so on this one here we had a confirmed upwards climate, the EMA, and I'm going to use a pink line here, the EMA was here and current price at this point was here. And so there's a difference, there's a gap, use another colour. There's a difference between these two, they're far away from each other. So if you had an EMA value that was down there, and you had a UFO that was, I don't know, let's draw it here. Sorry, let's say you had a UFO, then it lined up here at the same time, but current price is up here. So if current price then moves down, our EMA will also move down. And so by the time price hits the UFO, it no longer lines up with the EMA because it was far away from it in the first place. So it gives it more time for price to move and therefore the EMA to move and therefore not line up in the way that you want it to line up. Now, hopefully that makes sense, but I'll expand on that again and just explain it again before I take you to the user guide, which explains that very briefly. So let's say, for example, let's perhaps go to this date and time. This was the 29th of April. And let's see if we can find a good example here. So we're going to go bar replay. We're going to go back to the 29th of April on this side. This is Facebook. This is just, again, a random example. This could be stocks. This could be currencies. This could be cryptos. This could be anything. And we'll do the same on this side and we'll take ourselves back to the 29th of April here. There you go, 29th of April, I just saw it come up, and we'll go to the middle of the day there. Okay, so let's perhaps skip forward a little bit into the end of the day here, and if we can't see a UFO to make my point, I'll draw one to make the point. So still within the 29th, let's go forward another few, see if we have, okay, so this would be a reasonable example. So at this point, the EMA was 303.56. That's what the EMA was on that day. The EMA is the exponential moving average, and for those that follow this methodology, you'll understand that what we need to place a trade, first and foremost, we need the climate to tell us it's confirmed, either up or down. If it's up, we'll buy. If it's down, we'll sell. So in this case, the price was confirmed upwards. Then we want to know, if we're going to buy, where do we buy? And then we use our UFOs to help us with that. We have many different UFOs to choose from. So what we do is we need a third thing to line up. We need the EMA from the bigger time frame to coincide with the UFO on the smaller time frame. That's a very succinct explanation of the methodology. But essentially we need three things lining up definitely for us to place this trade. Climate going in a confirmed direction. UFOs that align with that. So in this case, buy UFOs because we're buying. And the EMA value coming together. That's what we need to place a trade. So at this point, the EMA value was 303.56. So that would have been around about Was it 303.56? Beg your pardon. So it would have been round about here, just between those UFOs. So that's where the EMA was. But price at this point was up here at 330. So it was $30-ish, $27 difference between current price and the EMA. Now, we wouldn't place this first UFO here. Why? Because it didn't line up with the EMA. The EMA, and what I'll do here is I'll just delete that. We're going to use pink for the EMA just to really show the different colour. So pink here is showing us what the EMA value was, this EMA value was on the smaller time frame. So we see it there. Now we had a UFO here that was close by, but nowhere near the EMA. They're not close to each other. That means if we want price to get into a UFO with the EMA, we need price to come down because that's where the EMA is. But as price comes down, our EMA value will also likely move down. The EMA, let's just do this here, is exponential. There you go, I think I spelled that right. Moving average. EMA. Now, clue is in the name here, moving. The EMA is showing us the average price of the last X amount of candles. In this case, it's the last 9 candles, and it's exponential because it puts more weight onto the most recent candles. But essentially, it's an average of the last 9 price points. If it's an average of the last 9 price points, then as we have new price points, it moves because it's following what price is doing. It's a moving average. So if it's a moving average, that tracks the price. Well, then as price falls, so too does the EMA. Now it may be that price falls, and by the time it comes to this set of UFOs, the EMA is now here, which is in this bottom UFO. But then as it continues to move down, the EMA is now here. It's outside of the UFOs, meaning it never lined up. It may have lined up at some point along that journey of price towards those UFOs, of price towards those EMAs. But as price moved, so too did the EMA. And so it fell outside of the UFOs that we would have wanted to use. So again, let's draw this just to be really, really clear. Because I know for some of you this might be a little bit confusing. I know for some of you you're going, yep, got it. I know what you're talking about. But I do understand, especially those that might be newer to the methodology. It might sound a bit like I'm speaking a different language. So I'm just going to explain it one more time and show you exactly what I mean. So let's say today's the 29th of April. Today's the 29th of April and we're looking at this opportunity, which is Facebook. We look at this opportunity and we say we have a decent, oh, this has gone to 11th of May for some reason. Oh no, we're fine. It's still on there. It's on the 28th of April actually. I'm looking at the wrong. What I'm going to need to do here is just do that. There we go. This is more my point. Here we go. So in this case, we had on the 29th of April, so apologies, that previous example was a day out on the left hand side. So 29th of April, we had a thick blue dot, confirmed probability to the upside, meaning we should probably look to buy. We had different UFOs, and in fact if we go through to the end of the day here on the 29th of April, right through to the end of the day, probably around about there. Yep, there we go. So we went through to the end of the day on April and this is what price looked like. And we had UFOs to choose from. The EMA value was 308.75, which is going to be around about here. Let's assume for the sake of this argument that at that same price we had a UFO. Brilliant. Then we've got everything lined up, right? We've got a thick blue dot, probability up. We've got buy orders from the UFO. We've got buy orders from the EMA. Brilliant. Everything lines up. We want to place a trade because we have enough probabilities going in our favor to the upside here. So we place the trade and we have our entry here. And we have our stop loss at maybe a little bit below. Maybe our stop loss would go underneath this UFO and would go here. So we'd have our entry and our stop and we'd have our targets. We'd draw them in and let's say we had another target up here. And that would be our trade. Great. But price is quite far from the EMA. So if price is here, let's assume over the next few days price starts to move down. And it's moving closer and closer to our entry. And we're going, great. we're about to get triggered. But because price has moved, so too has the EMA. And the EMA is now here, just as price is coming into our UFO. What do? We cancel the trade, because the rule is we place trades where the EMA and the UFO align, not where they used to align, not where they might align or could align, but where they do align. Sometimes we might anticipate it and we might have to cancel beforehand depending on the way price moves. But in this case, even if it moved out by a little bit, we cancel the trade because we no longer have the criteria lining up in the same place. If we think about it logically, what does the methodology tell us? The methodology tells us that we place this trade here. Again, let's get rid of some arrows and perhaps draw this out again. So we place this trade here. We had a UFO. We had our EMA in the middle. We placed this trade here. Why? Because we had thick blue dot, probability upwards. We had buy orders from our UFOs. UFO stands for unfilled order. So in a sense, it's showing us where we would have buyers. So if we had a UFO here, then that would tell us we have buyers there. Well, if we want to buy, and we know we want to buy because of this, we want to know where to buy. We want to buy where there's lots of other buyers, so we buy with the UFO. So if we're buying with this UFO, we also want to make sure that we also buy at the EMA because other buyers come in at that point too. So then we have a confirmed probability upwards, which tells us lots of buying. We have a UFO, which tells us lots of buying. And we have the EMA value underneath price, which tells us lots of buying. Buying, buying, and buying tells us we should be buying. The more buyers there are, the more price can go up. It's the only way that works. The only way price can go up is if there are more buyers than sellers. One way to make sure there are more buyers than sellers is to have a lot of buyers when you buy. That's what the methodology tells us. So if the EMA is no longer lining up and the EMA is here by the time price comes back down to it, no longer lining up with the UFO, well then okay, we might still have a thick blue dot, we might have probability upwards, we might have buy orders here, but we no longer have extra buy orders coming in from the EMA. So we have 2 out of 3 probability indicators here that there are buyers at that price point. You can still place the trade, that's ultimately up to you. If you said, I don't care about the EMA, I'm just going to use UFOs, well then great, place that trade, place that trade, place that trade. No problem with that. What will happen is you will end up placing a lot more trades, you'll have a lot more opportunities because it's not going to be ruled out or not based on the EMA because you will ignore it. You'll just place the trades based on the UFOs. What will happen is you'll have more trades, but more than likely they will be less probable trades. So let's make up the numbers, let's say out of 10 trades, instead of 5 of them being profitable, 4 of them are profitable. If you still have a decent reward to risk ratio, you can still make profit, you can still make money. I'm not saying not aligning the EMA means you'll lose money, far from it. You might even make more because you have more opportunities to trade. But what you will do is reduce the likelihood that that trade is profitable, meaning you might need to go through a few more losses before you hit a profitable trade. And then that can be, of course, a little bit difficult depending on your psychology. So if you want to increase your probability rate, you have more variables. For us, the variables that we combine, like I said, are the climate, the UFOs, and the EMA. If I just move this here, and the EMA, all at the same time, same price. That's what we want to happen. So if the EMA moves and is no longer part of that UFO, then we no longer place the trade because we no longer have enough probabilities to make that trade worth doing based on the way we view the markets. So hopefully that makes sense. I know I took a little while to explain it, but hopefully the different examples here make some sense. I'm just going to point you towards, and if you've got AutoClimate, you can go onto the website, or actually, I think even if you haven't got AutoClimate for yourself and you just want to understand a bit more about this maybe before you download it, if you go to the website, you can download this user guide, AutoClimate user guide. Now this is for the TradeStation version. You can also download the user guide for TradingView. I'll show you the TradeStation version in a second. And here, if you just, this is right at the top, I just came down and found the information on an ATR spread. You can, there you go. You can obviously do Control F and find it. So here, that's what this tells us. ATR spread. The size of the ATR spread vertical line, which is these lines above the dots, the size of that line represents the distance from the current price on the chart to an average ideal trading price, the EMA. The distance is measured in multiples of standard ATR, average true range calculation applied to the current time frame. So let me just dissect that a little bit. What that means is we have these lines. There's also numbers that represent those lines. So at this point in time, and let's freeze that, on the 29th of April, the ATR number that we had here, this ATR reference, was 2.81. You can see it there as well, 2.81. That means on this time frame, which in this case is a daily chart, price would averagely take 2.81 days, in this case, to reach our EMA value. 2.81 times what is a usual amount. So the longer the line, the longer it's going to take to be able to match those two things up, which means the more room you have for it not to line up anymore by the time it gets there. So let's come back to the user guide. The distance is measured in multiples of standard ATR, average true range calculation applied to the current time frame. Basically, it tells you the amount of candles you may need to wait for it to be able to come back. When the line is above the dot, that means that the price of the market is at a certain distance away from the ideal average trading price or average price and moving in the expected direction defined by the dot color. Ruby is down, sapphire is up. So let me show you here. Meaning, if we have a blue dot and the line is above the blue dot, that tells us that price is above our EMA and it's moving in the direction of the upwards dot. If we had a red dot, let me draw one. We had a red dot with a line coming out of it. That would tell us that price had a probability down. Let's say price did this. Price had a probability down and that it would be above the EMA. So in this case, let's say the EMA would be here. So in this case, if it's a red dot, that tells us price is below the EMA and price has probability down. And the long line above it tells us that price would be far to the downside away from the EMA. If it's a blue dot, that tells us probability is up, price is moving up. If it's a long line, then price is far ahead of the EMA to the upside. So either way, whether you're up or down, that line tells us how far price is away from the EMA in that direction. Now, if the line, let's go back to here, when the line is below the dot and becomes a grey colour, it means that the market is no longer moving in the expected direction and that the ideal average price has been exceeded. Essentially, that tells us that price has crossed the EMA. So let's find an example here. So if we see here, we have, let's take this one. So you see we've got that thick blue dot and it's got like a little tail coming out of it to the bottom. That was this day here. So let's find that on the chart. Brilliant. So that was this day right here. So in this case, if the dot is blue and price is moving upwards, usually that means price is above the EMA. But as we see here, price was below the EMA. It crossed it to the wrong side. So what that line on the bottom of the dot tells us is that price has crossed it to the wrong side. Meaning if we're in an upwards climate, if the line is above it, price is above the EMA. If the line is below the dot, then price is below the EMA. And vice versa if we're in a downwards climate. If we're in a downwards climate, let's take this one. If we're in a downwards climate, when the line is above the dot, that tells us price is below the EMA. When the line is below the dot, that tells us price is above the EMA. So it's just telling us, that line is telling us whether or not price is further ahead of the EMA as it should be in that direction, or whether or not it's crossed to the other side. So that's what our AutoClimate is telling us. It's a free app and we use it mainly just to tell us whether or not to buy or sell, very simply. But we can use these other things to do with AutoClimate to help us be a little bit more specific. So for example, you might see a great trade set up and then look here and say 2.81, it's going to be 2.81 days averagely before it would even get back to here. So this long line means I might not place this trade, because it might be a trade that I then have to come back and check on once a day for the next 2, 3, maybe 4 days to check whether or not it's still relevant. What I want is to be placing trades when the line is like this, when there's barely any lines. This one here. That's when I want to be placing my trade. Or when the line is like that, that's when I want to be placing my trade. Or when the line is like that, that's when I want to be placing my trade, when it's a little line. And so you can use this to also help you filter out the trades that you place your time on or not. So again, that's how you could use auto climate and the lines on it to help you figure out whether or not all of your different criterias are going to line up in the same place, or whether or not you've got a little bit too much room to allow things to change before it triggers. I'll just show you on TradeStation real quick. It's the same situation. We've got TradeStation on, we've got TradeStation that we're looking at here, and auto climate on the left hand side. It's exactly the same in the sense of the lines tell us how far away price is from the ideal trading price. If it's a long line, price is far away from the ideal trading price. If it's a short line, price is close to the ideal trading price. It would help if we saw price as well, just so you see how that works. If we have thin dots, we don't trade at all. If we have thick dots, that's when we are likely to be trading either up or down. We then go and look at our UFOs and our EMA, and if we want to make sure that if we see things lined up, it's unlikely to change before it triggers, we want to make sure that these lines are as short as possible. So hopefully that makes sense. So that's me now, having explained how we're using auto climate and how we are using the different tools here to help us figure out what we're going to be doing, what trades we're going to be placing, how long we might need to wait to get into a trade, and therefore how much room there is for the criteria to change before we take it. So hopefully that was helpful, and thank you to Steve again for the question on the tradewithufos.com/Becky link, because that means, again, I can take that, I can explain it, I can expand on it, and other people can learn from that question and from the answer as well, hopefully. So what I'll do at this point, I will cut off the live stream that we have going on in YouTube, Facebook, and other places as well. For those of you that have joined me so far on those free channels, hopefully you found that useful. Next week, I'm doing another sharpening session next week. I'm going to go into reasons why you may cancel a trade, whether you're in it or not. I will go through that next week. So join me there if you think that would be useful. Again, if you're coming to these sessions live and you have questions, by all means, come and ask the questions. I know sometimes people watch this and they don't necessarily have a question. They're just sort of watching and learning and taking in different things. But by all means, if I say something that doesn't make sense, let me know. If you have any questions, let me know. I'm here in these sessions to help you guys understand whatever it is that might be a bit confusing when you're learning this methodology and when you're applying it in these different situations. So I will cut the live stream now to the free channels, and we will continue in the closed coaching session. Any last minute questions, if you guys have them, please go to tradewithufos.com/Becky. Get yourself that free Trade with UFOs membership. If I just load that there at the top, then you can come and answer questions here, or ask questions here, and I will answer them. And if you have any other questions that you don't want to post here, you can email me, becky@traddictiv.com. So give me a sec, guys. For those of you that are with me in the closed coaching session, let me just cancel this stream to the other ones. Give me a couple of seconds whilst I do that, and I will then be with you. So for everybody else, take care, see you next time. And for those that are waiting on me, just give me a couple of minutes for me to do this.